Welcome back to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita Khemka.
And I'm Santosh Nair.
Well, Santo, if you look at the markets today, we were extremely volatile a day after hitting that 20,000 milestone. It was a milestone Monday, and I missed you yesterday. But of course, you're here today, so let me talk to you about, where the markets are headed from here. 20,000 is something that experts are saying was just a number. It's a journey, and this is just a milestone that we have achieved. But before I speak to you about how the markets are looking and what are your thoughts on that, let's just take a look at today's market action, so to say. We did hit a fresh high at open today as well. 20,110 is the all-time high level now that we are looking at. But of course, we came off that 20,000 mark towards the end of the session. If you look at some of the sectoral movers, lots of underperformers in today's session, at least, like the realty pack, PSU banking pack, metals, all of these indices shed somewhere around 2 to 3% a piece. It was only the Nifty IT and pharma pack that managed to hold on to gains. IT in fact gained somewhere around 1% or thereabouts. Among the top losers in trade today, Santo, we had BPCL, Power Grid, NTPC, Coal India. So a lot of these PSU names that had run up quite a bit came under some bit of selling pressure. Then we had Tata Motors. Of course, there was this commentary by Road Minister that came in saying that he has proposed higher GST on diesel vehicles. So that's something that spooked the markets. But again, there was a clarification saying that no such proposal is in the works. So because of this news flow, we saw the likes of Ashok Leyland, M&M, Tata Motors take a very sharp knock on the chin. But I think towards the end of the session, they did come off the lows of the session. But on the gaining end, we had L&T, TCS, Infosys, and Ultratech and Divi's Lab. But let's talk about the mid-cap end of the market, Santo. After the kind of run-up that we have seen, would you say the space is getting overheated, given the fact that Nifty mid-cap index has seen the worst fall so far this year, as in the worst day of 2023?
Well, it's been a pretty dramatic fall in mid and small cap shares today, with the small cap and mid cap indices falling by 3 and 4%. Nandita, yes, there have been concerns about overvaluation for quite some time now. Many players had been warning about it, that there's a froth building up in the small and mid cap space, particularly in the small and micro cap space. We had many funds that had in fact started restricting inflows into the small cap schemes. Then we had many market experts talking about it. Many brokerages also. In fact, yesterday Kotak Institutional Equities put out a note saying that they were suspending coverage of mid and small cap stocks because valuation had just gone completely out of whack. Now, looking at the sharp correction, the way in which the market has reacted and the way in which the stocks have come up, especially many of the railway and defense names, there is a feeling that maybe this is a peak. But Nandita, if you look at previous market tops like this or these kind of sell-offs, one thing is evident: even when the market peaks, stocks don't just start coming off in a straight line. What typically happens is that a lot of people who have missed out on the rally, when these stocks come off, let's say 10-15%, these stocks then start looking cheap from their all-time highs, and that in turn attracts a lot of buyers, because many of the investors who have opened their demat account, let's say over the last 6 months, most of them, according to people in brokerage houses, they have just been testing the water. They have not bought in a big way. The big buyers have been largely those investors who have been in the market since post-pandemic. So once the stock prices start to come off, let's say even if they were to fall by about 10 to 15%, then you'll see a fresh set of buyers jumping in, taking it higher, before another set of sellers comes and then starts to book profit. So this is likely to be a volatile trade, and the narrative is that earnings are looking much better at this point in time. So it's not as if you have really these fly by night kind of companies which have seen a sharp run up, but at the same time there's a counter argument too. Many of the stocks which usually investors wouldn't touch in a normal market, those stocks too have now become some kind of turnaround name. That is what the market is betting on. So both sides of the argument will only get to know over the next few days whether the stocks have peaked for now, but it's likely to be one crazy ride for some more time, Nandita.
Right, Santo, I had Nilesh Shah of Envision Capital on the show in the morning, and I had asked him the same question. I had asked him whether or not irrational exuberance is building up in the mid and small cap space. He was of the view that, mid caps are coming out of a slumber, a hibernation after, 5 to 10 years of underperformance. So he says that there is room for upside. Of course, when we speak about the rail stocks or the defense stocks, he said there is there is case for caution, but once there is a meaningful correction, since these companies offer multi-year opportunities, that is the time one should be looking at this space. Of course, we have seen run up like 60 to 80% up move over the course of the year for some of the names, shipbuilders, railway stocks, defense names. So yeah, there is case for caution, that's what he said, but he sees more room for upside when it comes to the mid and small cap universe.
Well, so Nandita, sometimes it goes like this, that when it's a bull market, you only hear positive news coming out all the time. So order books are firm, companies are executing well, margins are healthy, new contracts are signed, new partnerships are forged, and then when the tide reverses, you will find that every bit of news flow that is coming in is suddenly turned negative. So yes, it does look, I mean, there is to some extent merit in the argument that most of these companies, especially from the railways and defense space, they have a very robust order book. But right now it's also riding a positive news cycle, and these things tend to change very quickly when the overall mood in the market changes. And mind you, we are also now beginning to see some kind of cautious ratings coming in for many of this.
Right, BEL is one stock, of course.
You're going to talk about it in a short while.
Talk about that as well. But, let me start with HUL then, first of all, because it's a large cap and FMCG names haven't really participated in this rally, Santo. If you look at the moves on HUL, I think on a YTD basis, it has lost somewhere around 2% or thereabouts. And there are some cautious brokerage notes that have come in on HUL. Nomura has they have retained their buy ratings, and they have target prices in excess of where the stock is currently, 13 to 14% upside from current levels. That's what brokerages actually predict on the stock. But they've all maintained the fact that the demand picture is anemic. There hasn't really been any improvement, any signs of improvement when it comes to demand. There is competition from regional players who had vacated the market in times of high inflation and perhaps around pandemic as well. So now there's resurgence of competition from there. There is higher ad spends. So these things don't bode well for the operating margins and of course volumes as well, because HUL of course has taken price cuts. To focus in on volumes, right? So that is something that will continue going forward and which will erode into the operating margins as well as the revenue picture going forward. And if you remember, when the numbers came out for HUL, the volumes were already at a 5-quarter low. So bringing back volumes will be a challenge. Of course, we know there's a new management at the helm as well. In fact, Goldman Sachs is saying that volume and margin trends likely to continue lagging peers in the rest of the fiscal. So that doesn't bode very well for the company. Near-term headwinds for home care volume growth are also there, which has been flagged by Goldman Sachs. But there's one good report that has come out, and that's something that investors will take heart from. It's Macquarie. They have said that channel checks point to steady demand. Even though we've seen that the rainfall has been deficient in August, so rural recovery will be patchy, it will be slower. But Macquarie is saying that channel checks is pointing to steady demand. They must be alluding to urban demand, because rural demand of course recovery has been patchy, and going forward it will all hinge on how September rainfall also pans out, right? So that's one risk factor. But given the fact that Macquarie has a pretty good view on the stock, it says that festive demand and moderation in price cuts going forward is something that could aid volume growth in the second half of the year. So all in all, picture is pretty much mixed, because three brokerages are concerned over demand recovery, volume recovery, margin recovery. But Macquarie believes that perhaps around festive season we could see some bit of rebound coming in volume. So hazy outlook, and of course the FMCG as a pack, I think, has underperformed in the current leg of rally that we've seen in the market. So it's it's a verdict that isn't very clear. We'll have to see how things pan out. But for now, I think the outlook on FMCG is pretty hazy going forward.
Well, festive season is something on which many analysts are pinning their hopes on. So in the case of Jubilant Foodworks also, which had seen a sharp run up over the last few days. Today it did come off sharply, it fell about 3%. There also the big bet, or at least the narrative around the stock, is that come festival season and the Cricket World Cup, you will have people consuming more pizza. So that is what seems to be driving the stock up. Of course, the first quarter numbers were a big disappointment. Same store sales growth was pretty weak, and many analysts are of the view that probably the tepid trend in same store sales growth is likely to continue for some more time. Now, there was a time when Jubilant Foodworks used to enjoy premium valuations, but that was also a time when competition wasn't much. But now competitive intensity has increased quite a bit post pandemic. The pressure now on Jubilant Foodworks, according to analysts tracking the space, is that they need to diversify their offerings, and how well that works with the consumers, that is going to be a key trigger. Also the fact that pizza is a fairly mature brand, so it means that now if you just keep adding or increasing the number of stores, that really is not going to increase consumption of pizza, although it will increase your operating costs. And let us not forget, again, food inflation has started to inch up. Inflation overall continues to remain on the higher side. So these are some of the concerns for Jubilant Foodworks at this point in time.
But what about the valuation picture? Valuations for some of these stocks, QSR stocks, would you say they are stretched at the current juncture, or after the correction we've seen, they are at fair value now?
Nandita, always these things, the market seems to look at the earnings picture, how what the growth is likely to be, and then assign the valuation. So often the valuation just reflects what the market is now expecting. So if you have low valuations, it clearly means that market doesn't expect the growth to be all that high.
Right, that's the view on QSR then. But as we were talking about the defense stocks, I'm going to talk about BEL. This is one stock that has rallied somewhere around 45% over the last 6 months or thereabouts. And we have Axis Capital coming out with a report. It has downgraded the stock to reduce from add. In fact, the stock was down somewhere around 7% in today's session alone. So Axis Cap believes that the growth is already priced in and valuations are at record high. The stock is trading at somewhere around 28 times 1 year forward PE according to Axis, and according to them, it's pretty expensive given the fact that it's at higher than 2-year average mean. So, and it says that the large defense orders that the company had bagged could see some delays, and that could be a risk factor for BEL going forward. As I was mentioning, the stock has run up 46% over the last, on a YTD basis. But I want to also point out some other reports that were positive that have come out in recent times. Antique was one brokerage that had come out with a positive report. It said that even though valuations are where they are at right now, but it's justified given the fact that these stocks offer multi-year opportunities, right? And it believes that valuations right now are no way stretched when it comes to some of these defense names. And remember, the company had reaffirmed the FY24 guidance of maintaining 15 to 17% revenue growth, 20% plus margin, EBITDA margin, guidance, and the order inflow for somewhere around 20,000 crore rupees or thereabouts. In fact, for FY25, it believes the order book could be higher than this, as the government, of course, focuses on Make in India and defense manufacturing emerging as a big theme now. And the management has also been confident of achieving 15% revenue CAGR over FY23 to FY26. So the outlook painted by the management is fairly good, and the numbers were also fairly good in the first quarter. So that means there are conflicting views, of course, because the stock has run up so much. But as I said, experts point out that these stocks offer multi-year growth opportunities. So
the same point I was making a short while back, Nandita, when it's blue skies, you always try to extrapolate it into the future, but nevertheless,
it's the book to bill. I think that is something that would determine, right, how soon the company executes the orders it has,
and how soon, don't forget, how soon the government pays
them. Yeah, exactly. Well. That's what I was coming to.
Well, and the last stock on my watch list today is HDFC AMC. The stock also fell in line with the rest of the mid-cap space. The stock was down by about 1.5%. This stock also has seen a good run up. In fact, yesterday it hit a new 52-week high. Now, interestingly, despite inflows into mutual funds being quite strong, we are not seeing the same kind of frenzy for the listed stocks of the asset management companies. So, for instance, even though HDFC AMC has hit a 52-week high, it's still some way off from its record high which was seen in October 21. This despite the fact that assets under management have increased quite a bit. Now, one of the reasons for the underperformance was fears of tighter regulations. That has abated somewhat now. SEBI has also softened its stand. Of course, the final proposals are yet to be announced, but at the same time it has indicated that it would soften its stand. So, that has given a breather to asset management companies. But the bigger problem as analysts tracking the space say is that asset management companies need to improve their yields. Till that happens, you're unlikely to see a big re-rating of the sector as a whole. So, the concerns over tighter regulations, those have abated. Also in the case of HDFC AMC, the stake sale by Aberdeen, that has reduced a big overhang. Till some time back, the concern was that Aberdeen would be a seller at every level. That has been allayed to some extent, but if you look at the earnings again, that's been in a narrow range for almost the last 4 or 5 quarters. So, that is where market needs to see an improvement for the stock to re-rate.
All right, and of course, Santo, if you look at the 6-month chart for HDFC AMC, up somewhere around 50% or thereabouts. So, even though it did come under pressure after the entire TER thing panned out, but it has staged a good recovery ever since then.
Always depends on at what price you bought the stock.
Yeah, that's true. But with that, I think we've come to the end of this edition of Closing Bell. If you have any comments, let us know in the comment section below, and of course we'll take note of that. But I'll be back with the markets at 8:30 a.m. tomorrow, so don't forget to tune in. But for now, it's a goodbye from me and Santo. Thanks a lot for tuning in. For all your other news and updates, stay tuned to Moneycontrol.